Hey everyone, welcome. So you've got an annuity, or maybe you're thinking about one. You know they're a great tool for retirement, but let's be honest, the way they're taxed can feel, well, a little complicated. Today, we're going to pull back the curtain and make it all super simple. And let's just start with the single most important thing to remember. Every single dollar you take out of that annuity is going to have some kind of tax consequence. Knowing the rules isn't just a good idea, it's absolutely essential. Because really, that's the whole point, isn't it? Knowing these rules is what allows you to build a smart, tax-efficient strategy so you can keep more of your hard-earned money right where it belongs, in your pocket. Okay, let's dive right in. When you get down to it, all the complexities of annuity taxes really start with one single question. Where did the money come from in the first place? See, there are two main flavors. First, you've got a qualified annuity. Think of this as money you haven't paid taxes on yet. It's funded with pre-tax dollars from something like a 401k or a traditional IRA. Then you have a non-qualified annuity. This is funded with after-tax money, cash you've already paid your taxes on, maybe from a savings account or a CD. And this is where that choice makes a world of difference. For a qualified annuity, since you never paid a dime of tax on that money going in, 100% of every dollar you take out is taxable. Simple. But with a non-qualified annuity, you already paid tax on that initial chunk of money, so you only have to pay taxes on the growth, the gains. Your original investment comes back to you completely tax-free. Let's make this real. Meet Jane. She rolled over $200,000 from her old 401k to buy a qualified annuity. So that's all pre-tax money. Now, when Jane starts getting her annual payments, let's say it's $20,000, the entire amount, all 20 grand, is taxed as ordinary income. That's it. Okay, now let's flip the script and look at John. He took $100,000 from his savings account, money he'd already paid taxes on, and bought a non-qualified annuity. So over a few years, his annuity does its thing and grows to $150,000. This means he has his original 100 grand principal plus an extra $50,000 in gains. And when it comes to taxes for John, it's that 50 grand in gains that the IRS has its eyes on. This brings us to a very specific and kind of quirky IRS rule for non-qualified annuities. It's often called the gains first rule, and you definitely need to know how it works. The official name is LIFO. It stands for last in, first out. Just think of it like this. The IRS views your earnings or your gains as the last money that went into your account. So they say it has to be the first money to come out. What this means for you is that your withdrawals are fully taxable until all of your gains have been paid out. Only after all the gains are gone do you get to your tax-free principal. So let's walk through this with John. He puts in his $100,000. It grows, giving him $50,000 in gains, and now he wants to pull out $20,000. And there it is, the LIFO rule in action. Because he has $50,000 of gains sitting in that account, the IRS considers his entire $20,000 withdrawal to be gains. And because of that, it's all taxable. He's going to keep paying taxes on his withdrawals until that full $50,000 in gains is gone. Okay, now that you've got the basics down on qualified versus non-qualified and that LIFO rule, let's talk about a couple of really common tax traps you absolutely want to steer clear of. The first major thing to be aware of is this number, 10%. This is the IRS penalty if you take money out of your annuity before you hit age 59 and a half. And here's the kicker, this is a penalty on top of the normal income tax you're already going to owe. It's a double whammy, and trust me, it's a very expensive mistake to make. All right, let's quickly bust two huge myths that catch people all the time. First, people think annuity gains are taxed at those lower capital gains rates, like stocks. Nope, they're taxed at your regular ordinary income tax rate, which is almost always higher. Second myth, that your kids get a step up in basis when you pass away. With some assets, that's true, and it wipes out the tax bill for your heirs, but not with an annuity. Your beneficiaries actually inherit your tax bill on any gains left in the contract. So, with all these rules and traps, what do you do? Well, it's not just about paying the taxes you owe. It's about being proactive and planning ahead to make your retirement income as tax efficient as possible. You know, figuring out when to take withdrawals and how to structure them to keep your tax bill low, that's a whole strategy in itself. But the good news is you absolutely do not have to figure this out on your own. At The Annuity Expert, this is what we do all day, every day. We help people compare different annuities and strategies. And by the way, our services are always completely free.
So if you'd like some help, if you want to shop around and really compare the right annuity for your specific goals, please just reach out. You can give us a call for a free consultation at 770-755-1565, or you can find us online at annuityexpertadvice.com.
So now that you've got a handle on how annuity taxes work, it's the perfect time to ask yourself, what's the next question I should be asking to make my entire retirement plan that much stronger? Thanks so much for watching.